Good morning, everybody. Appreciate you joining here this morning. My name is Craig Wendell from Managing Director on the line. I also have Greg Pepperman with me, who's the director on the team here. Greg, why don't you go ahead and introduce yourself and we can get started.
Hi, good morning, everybody. Thank you for joining us here on this Thursday morning. As Craig mentioned, my name is Greg Pfefferman. I'm a director of M&A services here at Align. Today, thank you all for joining. Today, we're going to give a little review of the interest rate environment in the marketplace and how the interest rates, inflation have affected the economy and the lower middle market. Before we get started, I want to introduce everyone a little bit to Align, make sure that everyone knows a little bit about what we do. We are a lower middle market investment banking practice. We've been around since 2017. We've helped business owners receive exits, approximately $2.25 billion in transaction volume since our starting. Across the members of our deal execution team, we have closed hundreds of deals totaling over $10 billion. Our team is comprised of operators, CPAs, MBAs, reformed business executives, and career investment bankers alike. Our team has received some great press in terms of being named a top mid-market M&A consultancy over the last 4 years, and under the leadership of our CEO, Dina Jalbert, we've consistently had 250% year-over-year growth, and we're looking for a really strong year this year. With currently there's 18 deals in our pipeline. You know, one of the main reasons we've enjoyed the success with our clients is we have a consultative culture. We do take pride in surrounding the families and entrepreneurs that we serve with a strong holistic team to give that top level advice. I'm going to hand it over to Craig unless there's anything that you wanted to add with respect to our business model. And Craig's going to do a little bit of some updates on the type of businesses that we serve and maybe talk a little bit about some deals that we currently have. Craig?
Sure. Yeah. Thanks, Greg, and appreciate that. And I think what you're hearing from Greg and really what is fundamental to Align is the educational process that we take our clients through. You know, as mentioned here at the top of this slide, 2.25 billion across an array of industries. Admittedly we'll talk about this later on today, but we're really focused on the healthcare, industrials, and business services segments of the market today. And this is really predicated based off of what investors are looking for: stable cash flow, less cyclical overall businesses to the overall economy that are effectively not recession-proof, but recession-resistant. We've done completed a handful of deals this year already and are set to have a great year. We actually just completed a food and beverage manufacturer and co-manufacturing deal this week, which was a platform deal, market making deal for our client, and that was highly successful. We've also been quite active in the healthcare space, particularly on the physician practice management front. And then, you know, obviously in the home services, HVAC, plumbing, electrical, and mechanical has been a significantly hot sector for us. I think of the 18 deals we have going on right now, I would say 6 or 7 of those are in the services space today. Let's jump into a little bit about the next slide, Greg, on the challenges that are facing business owners, frankly, advisors to business owners, and that really is predicated based off of the interest rates that we're faced with today. The Fed's increased over 500 basis points, 525 basis points over the last 10 meetings in a very, very rapid pace. And so,
Right. Appreciate it, Craig. Yeah, I can take it from here a little bit. Yeah, to no one's surprise, the Fed, as Craig mentioned, did raise the base rate in the last meeting, which marks the 10th consecutive raise. That's over 500 basis points over that time period, and we're looking at the highest level that we've seen since September of 2007. If you're looking at reading into the notes and Powell's public comments, they appear at this point to be what they're calling a hawkish pause, signaling that they may be done. As a matter of fact, into the June meeting, the markets are predicting about an 80% of a pause. Headed into that meeting, Powell has said that they're going to be very data dependent. So the market's going to be watching closely the inflation numbers, which do appear to be cooling, and the jobs numbers, which do remain robust. One of these things is how has the higher interest rates, the inflation, impacted the market? Well, you're certainly feeling it in the private debt market, certainly in the upper to middle market. Costs of capital are increasing, and access to that credit for borrowers has been on the decline. We're seeing companies that have weaker credit profiles are struggling to secure financing at affordable rates. So while we're seeing the inflation numbers stabilizing and job numbers still looking strong, the market's still fearing a recession in late third quarter. Credit remains tight. Banks have been looking to strengthen balance sheets amid this turmoil, and there's a lot of thought that the recessionary pressures will kind of roll over into first quarter of 2024. So while we've seen this rapid change, 10 consecutive meetings, 500 basis points, a credit market tightening, there's certainly implications across the entire marketplace, from public equity, public debt, into the private equity market. The question for us today is, how has this affected the private equity market this year? What's our view of the market, especially as it relates to the lower middle market? So now that we've gotten a nice background of where we've been with effect to the interest rates and inflation, how they're overall affected the market, Craig's going to walk through a little more granularly how they've affected the private equity market and what the thinking across the private equity universe is. So, Craig, I'll hand it over to you here.
Yeah, thanks, Greg. So as Greg mentioned, I mean, there's no secret. Interest rates have increased substantially. What has this done to the overall market, and particularly the deal market? Is the deals in the upper market to the higher middle market, these deals that are 500 million plus have all but dried up. There's been a lack of access to institutional capital. Leverage buyouts have declined year over year. But what is that providing to deals that are in the lower middle market, right? Deals that are sub 500, deals that are even sub 100 million. You're seeing higher quality dollars chase higher quality assets. And what you're also seeing is a little bit of higher equity checks from these private equity investors and institutional investors, which effectively, have some type of suppression on the purchase price. But long term, there's still the ability to do some debt recapitalizations and provide multiple liquidity events for these business owners. Private equities, long-term outlook is very strong. Last year in 2022 was the second best fundraising year on record, meaning new funds are sprouting up at higher dollar values as well. This was the second best year, like I said before, only second to 2021, when obviously people know we had helicopter money, stimulus money coming down from the federal government. So that's a testament to the market's overall appetite and flavor for call it alternatives of private equity investing, as opposed to really just looking at the broader market. If you look at the broader market compared to the private equity market, we remain extremely bullish on the private market versus the public, and really truly believe that this is a great place, not only to hide out in potential recessionary call it tranches or over the next quarter or into Q1, but also long term, right? The returns in the PE space, particularly for lower middle market companies, is going to be quite robust. Let's jump to the next slide, Greg. It talks a little bit more about the size of the deals. What we've been seeing in the lower middle market, right? Let me define that for you. Is deals that call it $100 million or less, or potentially add-on or growth type of transactions that happen. And I'll turn your attention to the left side of the page here in 2023. You can see that deals between, call it 100 million to 25 to less than 25 million have really sequentially increased, right? In 2022, it was 77% of overall buyouts in 2022. That has increased over to over 80% in 2023. Keep in mind the historical average of this is about 63%. So as we mentioned at the outset of this call, you're seeing money move down market, and you're seeing it happen quickly, right? A large play in the PE playbook is buy and build strategies. And so what that means is they initially have a platform deal that happens, and then they're going to go to lower middle market, these smaller companies that are complementary to their broader company, and do transactions at a greater frequency. They already have term loans in place on their larger company to be able to transact these smaller companies. And these are, like I said, these are companies that maybe have $1 million to 5 million worth of EBITDA or cash flow. And the appetite, like I said, for quality assets from the investor community, from the PE world, is just increasing at a staggering rate, and the data shows it here on this slide. So we talked about a little bit about the opportunities. Greg, I'll kick it back over to you to talk about opportunities, particularly in the lower middle market. I think what you're hearing from us today is really that, despite the economic headwinds that are riddled all over CNBC and Fox Business News, there's multiple opportunities, great opportunities for businesses today. But more importantly, the opportunity to transact today versus riding out another cycle is paramount. And educating business owners on that, and providing the roadmap to execution is really how we work and what we do to be our trusted advisor to our clients.
Thank you, Craig. Great intro here of where the opportunities really lie, and where the focus kind of has shifted, because of all the things that we had mentioned. The lower middle market is becoming an attractive segment for M&A activity, certainly for the add-ons into a platform company. But as private equity looks to do deals, capital structure ends up getting in the way as the cost of finance via debt becomes a little bit expensive and makes the deals unattractive. As a result, lower middle market companies are a little bit more resilient in the rising interest rate environment, and they're more flexible to adjust their business models. So a quote over here I have from the E&Y's Global Chair of Strategy and Transactions, where she says, and she's right on point, deal financing challenges with the higher interest rates, increased cost of financing, are making smaller deals more attractive, and that's what Craig was demonstrating in earlier slide, and that's where the migration of deals are headed. And our thesis remains that business owners looking for nearing retirement should consider selling some, if not all, of their assets today. Market will continue to have a high demand for high quality companies, and there are plenty of opportunities, as mentioned, for the buy and build strategies. And certainly these rising interest rates may end up driving up competition among buyers, as the buyers who normally don't look in the space, who are flush with a tremendous amount of capital that they need to spend. Not only was 2022 one of the highest years on record, but there's still fund vintages dating back to 2018, 2019 that still need to be put into the market. I think there's close to $1 billion in private equity money alone that are going to drive these opportunities. And as the shift goes from the 100 million plus into the 100 million and below, we think it's a pretty strong marketplace for the lower middle market. And we'll just conclude a little bit before we do open it up for questions, kind of go over what we discussed We did talk about the private equity fundraising being strong. Now that we've seen a little bit more foresight into where the Fed is with their terminal interest rate, there's a little bit more uncertainty in the market. One thing marketplaces don't like, whether it's certainly in the public markets, but also within the private markets, is that uncertainty. We have a stronger feel of where the markets are heading now. Again, as discussed, the lower middle market, we feel, are going to continue to remain in high demand as the private equity portfolios are chasing the buy and build strategies. Add-ons, I think in the previous slide we discussed, was about 80% of activity in the first quarter, and that'll continue to be strong. And again, while the rising interest rates are presenting some challenges, the lower middle market may still provide some attractive opportunities for buyers and sellers alike. We were just in Forbes talking about the very same thing. This is a little excerpt over here that I pulled from the article, which is why mergers activity in the middle market remains hot, where Align has been very, very public with our thesis that the volatility in the public markets, increasing cost of debt, the dry powder are the main drivers of the investors coming down into the lower middle market space.
Yeah, and I would just finish before we open up the questions here. Greg hit the nail on the head, right? You have over $1 trillion of dry powder or literally cash sitting in these private equity checking accounts or savings accounts right now because they're getting a little bit of yield today. And there's a finite amount of time of when they can put that money to work. And that $1 trillion worth of dry powder historically has been before COVID. So 19, 18, 17 has been 60% of that, or 600 million, right? So you're seeing almost 100% increase in the amount of dollars available from an equity perspective size. And when you think about the capital structure of a transaction, the equity portion is typically average 40%. In COVID times, it was 20% to 25%. So what that means is that there's a whole lot of additional incremental dollars from a deal structure perspective with debt and different debt structures to be able to have additional frequency of deals. So effectively, if you put a leverage multiple on the dry powder sitting in these private equity accounts, you're looking at nearly $3 to $4 trillion worth of deal capital that needs to be put to work. And we're seeing a strong influx of private lenders completing deals with private equity firms as opposed to the institutional lenders, just given where the Fed funds rate is. But as we have greater foresight into the terminal rate, which we think might be a quarter basis points higher, maybe 5.25 to 5.5, we're gonna see more deal activity, and that money needs to be put to work, and it's gonna be put to work on the higher quality assets that are really kind of in this lower middle market. And the last thing I'll note to you is obviously the growth of the private equity markets and institutional investment into Main Street businesses has increased over the last 5 years, really accelerated over the last 5 years. But we're also in this obviously technology age where there are a number of these smaller companies that have the ability to really have a nice strategic and synergistic impact on broader companies. And so that's another very important iota of why institutional investors, private equity firms are coming down market, right? If they buy a company for $20 million or $30 million into a larger company, if that company has some proprietary knowledge or proprietary process of doing something, and it instantly has the ability to increase margin of the larger company that's acquiring it, those are the quality assets of private equity is chasing, and that's how you drive incremental value. And obviously us at Align, we hone in on that, and we're very tactical and strategic in our approach to the market to be able to deliver those results. So I'd like to open it up for questions to those of you on the phone/screen. I think perhaps the easiest way to do this is to type it in the chat, and we can address it from there.
Hey, Craig, I'll start off with a question just to get everyone warmed up here. What do you see are what industries are seeming to be the most popular amongst the private equity world in terms of add-ons specifically, but in general, I'd like to hear what your thoughts are.
Sure. Yeah, excellent question. It's no secret home services, right, is the hottest one. What is now becoming one of the largest thesis of private equity firms over the last 2 years, and this really has been accelerated from the COVID era, is everything that you spend on your home, whether that's your heating, ventilation, and air conditioning, your electric, your plumbing, your lawn service, your pool service, your pest control. Every dollar that you think about spending around your house, these investors want you to call one name, right? Call one number, and they want to basically control that spend of your home. So that's why you're seeing just a torrid pace of acquisition in the HVAC space, in the exterior remodeling space, think roofs, think siding, in the plumbing space, right? And long term, eventually what they want to do is essentially be, the Costco service of the home, right? And have one company, one number that you call for all of your needs of your home. So that's the long-term thesis of the investors from the private equity world. And the reason why it's just so hot right now is because whether in a recession or not, you still got to heat and cool your home. You still got to fix that leaking pipe or that drain that's not draining, right? You got to fix that electrical outlet. You got to repair your roof, right? No doubt there's been some severe weather that's been happening all across the country, and that's going to continue, right? So being able to capture that spend is really exactly what these investors are after. And second to that, I would say really in this industrials bucket is niche manufacturing businesses that really have a strong moat around them and have some type of IP or proprietary process or know-how or way of doing, is something that investors are looking at, and bringing that together with the home services space. They're also looking at the manufacturers of your HVAC or of your roof or siding, right? So it's really it's encompassing everything that's related to human beings and individuals, and the spend going around their lives. It's not the
Craig, we
do
have
it yourself. It's not the do it yourself era anymore. It's the do it for me era.
Absolutely, Craig. We have another really good question come in. What trends are you seeing in terms of transaction structure, e.g., more or less PE minority versus majority investments, cash up front versus contingent payments, like earnouts, longer closing timeframes. Maybe if you can speak to deal structure and timeframes, that might be helpful for the audience.
Yeah, excellent question. And this has been a hot ticket for us over the last 12 months, 18 months, particularly with our clients of aligning valuation expectations. So, in 2020 and 2021, just an immense amount of cash was out there, and we saw a lot of deal structures that were very high in cash, and some rollover equity, no contingent considerations. Literally, people were just throwing money at companies. That obviously has dwindled into more complicated deal structures, or what I would call normal deal structures, of the past 10, 16 years here. I would say, we're seeing lenders definitely tighten their belt. Cost of capital has clearly increased. I think paper today typically is anywhere between 8 to 12% on these transactions. Debt leverage or a percentage of debt as the deal structure has decreased. We talked about it earlier. Equity check size have increased, and that's normal in a higher interest rate environment. Contingent consideration vis-a-vis earnout, yes, certainly we're seeing more of that. We have been seeing buyers ask for seller notes. We hate seller notes. You're not going to buy my company and have me finance the acquisition, right? It's just not appropriate. So we're obviously getting those out of our transactions. and really putting some of that consideration into earnouts. For example, we're doing a deal right now in the Midwest, and these guys are, it's an exteriors business, roofing and siding and windows and whatnot, and they own their market, and they've had a nice run up. They're going to have a significant run up here into the back half of this year into next year. Had some very nice, call it Mother Nature events that happened for them that has increased demand overall across the board. And what that entails is, a business that's going from, call it 10 million to 20 million in 12 months. The sellers are looking to continue to grow and have a great, strategic growth plan. But what we're structuring in terms of that deal is, okay, provide us cash and rollover equity today, but then let's go set the carrot for the next 2 years for these owners who want to continue to grow and stay on, of having the ability to go out and collect an additional millions of dollars over the next 2 years. And so, what we're structuring there is a 12-month and 24-month earnout based off of revenue with a constant gross margin percentage. And so, we get flexible in the structures. We get obviously creative, but most definitely the structures that we negotiate are seller friendly. But yes, they have certainly changed from the last 24 months or 18 months.
Great, thank you. While we wait, if you have any questions, that'd be the time to post them into the chat. 1 second here. And that'd be the time to post them into the chat. But I'll ask this, Craig. We have a lot of advisors here on this call, and I'm sure maybe prior to our conversation, there was a thought, well, there's a business is tougher, credit is tighter, rates are higher, recession is looming. Certainly thoughts that would be, hey, if I want to go through a liquidity event, I should wait. But what are the opportunity costs for waiting for the market to recover? And also at the same time, why don't you add what are some things that clients and advisors can do to prepare to take advantage of these opportunities?
Yeah, good question. From an advisor perspective, you really are, that first line of defense for your business owners, and really the sounding board to them. We have a lot of businesses right now across the United States that are owned by the baby boomer generation, and have weathered multiple different economic storms. And so what I'd say to those advisors is, and advisors talking to your clients is, do you have the appetite and/or want to continue to go through the brain damage of weathering another storm, right? The private markets today offer you an attractive liquidity event, and by the way, offer you multiple liquidity events, right? So what it can provide is greater velocity to a greater frequency of cash flow for your business owner, diversifying themselves, taking the risk off of the business, not checking your bank account, your business checking bank account to say, oh, I'm okay, I don't need to do a transaction, but actually thinking about the diversification of your dollars and parlaying that with the risk that's out there in the overall macro market. There's significant geopolitical risks out there that are beyond any type of capital markets appetite for continuation. There could be COVID 3.0 or 4.0 that could come out of left field. So those types of risks are out there. And so, what the private equity world and institutional world and the private side has provided is a significant avenue, a very lucrative avenue for these Main Street businesses, these lower middle market businesses, to have, again, a liquidity event today, and then likely have another one in 3 to 5 years, and then potentially another one in 3 to 5 years after that. We did a transaction, I think it was 3 or 4 years ago now, and the guy's still rolling equity. He's literally playing golf and fishing, and he gets a call, and he's got another $3 million wire coming in. So, I mean, those are the types of opportunities that are out there for those business owners. And as an advisor, we like to be, a knowledge board or a strategic partner with those advisors to help give them some clarity and some avenue for their clients to be able to understand what is truly out there from a capital perspective and liquidity event for those business owners.
And yeah, I absolutely agree with that sentiment. I would also add too, Craig, is within the lower middle market world, we sometimes get lost in the noise of the public markets and the top end, where we're watching CNBC and Fox Business News and Bloomberg aren't necessarily talking about the HVAC manufacturer type of business. They're looking at top line and how global politics and global economics are affecting the marketplace, where they don't necessarily, as we showed in our presentation, apply to the marketplace that we look at. One thing too in preparing is I would definitely have a conversation, give Craig or myself a phone call. We'd be happy to discuss what the marketplace looks like specifically with respect to any individual company, where we have the opportunity to kind of see how deals have worked out recently. We make I know you and Dina and other members are on the phone with private equity groups all the time, talking about what they're looking at in the marketplace. So we're acutely aware of what's going on there, and it's always worthwhile to have a conversation. We like to say, if you're thinking about selling your business, let's just have a conversation to help position you, let you know what the market is looking like. So,
Greg,
sorry,
before we go to the next question, I would just add one thing, right? Preparation is key. These deals don't happen overnight, right? It's typically 5 to 7 month time frame. Owners do, sometimes have an idea of what they want to sell their business for, and likely that valuation basis is not accurate, right? So, what we do is we provide that education to them. We do a ton of deals. We do 20 to 30 deals per year. We're not a valuation firm, but we provide pro bono valuation to our clients upfront, free of charge, to really show them what's happening in the markets. We're in all these different sectors, trading businesses every day. So we see what is market, what's not market, and then further we have the ability to continuously improve on our deal structures and be able to extract premium value for our clients. But preparation's key, and that really comes down to talking to your clients early, bringing in an M&A team like us early that's going to do some education, some upfront pro bono work to be able to say, hey, 20 million is your number, but you're really only at 10 million today. Here's X, Y, and Z of what you can do to get to that 20 million valuation number, within the next 6 to 12 months, right? Or if they don't have that time period and don't want to do that, the beauty about these structures in the private markets is that you can roll equity, right? And so you become an equity holder in a larger organization. You own a smaller piece of the pie, but you've de-risked yourself. You've still got skin in the game. You still have the ability to have that second bite of the apple, which we've seen it a lot, is typically the same size or bigger than the first bite of the apple. And then that can provide you, an additional avenue to that $20 million mark that you can do in 5 years, as opposed to potentially doing it by yourself over 10 years.
And with that, a great follow-up here, Craig, to what you were talking about that 10 million, $20 million number is, how are business owners clinging to that magic number, or owners getting more comfortable with the reality at a different sales price, higher or lower than they initially planned? That was a question that came in. How do we manage that process with the business owners?
Yeah, excellent. Again, another excellent question. It's it's tough. I mean, it's not easy, right? But again, it comes down to education. It comes down to telling them and showing them, why market prices are the way they are, and then the opportunity for additional upside. Like I said earlier, vis-a-vis EBITDA earnout or revenue earnout or rollover equity. It's telling the business owner and showing the business owner through multiple different case studies, and multiple different collateral pieces of saying, hey, you think your business is worth $100 million, but it's really only worth 50, but here's the pathway to get to $100 million, right? And then from an advisor perspective, you think about it okay, they really want $100 million, but all of those assets, right? That 100 million that could come into my assets under management is all tied up in this guy's business. If he transacts, today for 50 million, you're gonna pull some of that cash into your business, right? You're gonna diversify his holdings. You're gonna be able to start planning for generational wealth beyond just him. He still has skin in the game and equity upside, but also his diversification of his dollars or his money provides multiple different avenues to create additional liquidity on that. So it really comes down to education and telling them that you really, as an advisors and as folks who've done this for over 20 years, you really don't want to have all of your liquidity tied up into your own business. Look at it's all over the news now, and frankly, we don't really have a strong opinion on it. But you look at artificial intelligence, chat GDP, right? So what you're seeing there is the opportunity for a ton of folks and a ton of employees losing their job just because of artificial intelligence, right? You look at a company like Wendy's who's thinking about doing underground delivery to takeout. So that's goodbye to the drive-through window, right? And you're just going to pull up into a slot and it's going to come out just like a bank teller chute. So you're seeing all this innovation happen. And effectively, what that means is that if you're tied up, if you have your business, if you have your liquidity tied up in your business, you could have a new entrant that comes in and squashes the valuation of that business, tomorrow. So diversifying yourself, diversifying your money is critically important. And so it really gets back to education, Greg.
Absolutely. Thank you. I think at this point, I don't see any other questions. If anyone didn't get their question answered or had further questions, certainly feel free to reach out to Craig or myself. Craig is cwendell@alignba.com. And I'm G. Pfefferman at alignba.com. Happy to answer all your questions, have any sort of follow-up. If you've got anyone that you think would benefit from this conversation or this presentation, feel free to reach out to me. I put my email in the chat to get a copy of the presentation and set up something either individually or with any of your clients. I appreciate you guys joining us on Thursday morning.
Thanks, everybody.
Appreciate it. Goodbye.